So let's get right into it. Today, we're talking about Apple, ticker symbol AAPL. And we're tackling the one big question on everyone's mind. Is the world's most valuable company still a smart investment? Or is its fortress about to face its biggest test ever? I mean, get this. On one hand, Apple just wrapped up a massive $416 billion year. That's an all-time record. But on the other hand, there are some serious storm clouds gathering. You've got fierce new rivals and regulators on both sides of the Atlantic taking aim. So, what's the real story here? To figure that out, here's how we're going to break it down. First, we'll dig into Apple's competitive fortress and the biggest risks it's facing. Then, we'll run a health check on the financials that truly matter. After that, we'll get into the valuation and the huge AI question. And finally, we'll give you our definitive verdict. All right, first up, let's talk about the fundamentals. We need to understand Apple's core business and the major challenges it's up against right now. You've probably heard this term before, but the key to Apple's absolute dominance is its economic moat, what everyone calls the walled garden. And it's honestly brilliant. You've got the hardware, right? The iPhone, then the software, iOS, and of course, the App Store. They all work so perfectly together that it's just really, really hard for customers to leave. That integration is the foundation of their entire company. And here's where you see how that moat turns into just mountains of cash. Now, no surprise, the iPhone is still the king, pulling in almost $210 billion. But look at this. Look at services. Over $109 billion. That is a gigantic business in its own right. And this is so important because, services aren't a one-time sale like a phone. It's recurring revenue, and the profit margins are way, way higher. Honestly, that's the engine for Apple's future. But that fortress, well, it's being attacked from two sides. Over in the East, you've got Huawei coming back in a big way. Their new phones are seriously eating into Apple's premium market share over in China. And then, back here in the West, it's a full-on regulatory assault. You've got the U.S. Department of Justice and the EU's Digital Markets Act, both taking direct aim at that walled garden, specifically that super profitable App Store. Okay, so with those big risks looming, let's pop the hood and see if the company's financials are strong enough to handle the pressure. It's time for a financial health check. First up, revenue growth. The easiest way to think about this is like the company's annual paycheck. And as you can see, it's not just getting bigger, it's actually accelerating, jumping from $391 billion to $416 billion in a year. That's a huge signal that people are still lining up for their products, even with those premium price tags. Next up is pricing power, and we measure this with something called gross margin. That number, 47.2%, wow, that is just staggering. It means for every single dollar Apple makes in sales, they get to keep more than 47 cents as gross profit. For a company that sells hardware, that is an insanely high number, and it tells you everything you need to know about the power of their brand and that ecosystem. Okay, let's talk about debt. Now, a debt-to-equity ratio of 1.23, on the surface that might sound a little risky. The analogy here is like having a $123,000 mortgage on a $100,000 house. For you or me, that's a problem. But for a company like Apple that is just a cash-generating machine, this is nothing. It's actually a very healthy, very disciplined level of leverage. They're using debt smartly to grow without putting the company at risk. And that brings us to the most important thing, cash. Operating cash flow is like the company's actual take-home pay, and generating almost $30 billion in cold, hard cash in a single quarter is just phenomenal. This is what gives Apple that incredible flexibility to do whatever it wants. Pour money into R&D, pay dividends, buy back stock, you name it. So the financial health, it's clearly top-notch. But that leads us to the million-dollar question, or I guess the $3 trillion question. Is the stock actually worth its price tag right now, and what's coming next? Well, if you ask Wall Street, you're going to get a lot of different answers. There is a huge range of opinions here. On the low end, you've got Barclays basically saying sell it with a price target of $230. Then in the middle, Goldman Sachs is a buy at $320. And then you have this Super Bowls like Wedbush who see it going all the way to $350. This huge spread really tells you the story. There's a big debate going on. All right, so let's talk about the bull case. It all comes down to two words, AI Supercycle. The whole argument is that Apple is about to cash in, big time, on its massive base of 2.2 billion active devices. How? With Apple Intelligence. These are new, exclusive AI features that are going to run right on your phone, not in the cloud, that makes them faster, more private, and it's going to make millions of people say, I have to upgrade my iPhone. And of course, this is all powered by their own incredible chips, like the new M5. But then you have the bears, and they're pointing right back at the risks we already talked about. They'll tell you the stock is just too expensive, trading at a price-to-earnings ratio of around 31. They see that tough competition from Huawei and China and those huge regulatory threats from the US and Europe as real, genuine dangers that could totally knock the wind out of their sails. And there's one big cloud hanging over all of this. This quote from the research really hits the nail on the head. Basically, the cost of making these super advanced chips is going up, and it's not coming back down. If Apple has to raise iPhone prices even higher and customers finally push back, well, those amazing gross margins we just looked at could be in real trouble. Let's bring it all home. It's time for the final verdict and our definitive recommendation. All right, so we've looked at the incredible moat, the very real risks, those rock-solid financials, and the intense debate raging on Wall Street. Now it's time to put it all together and make the call. After weighing everything, our definitive recommendation is a buy. And we're not just saying buy, we are setting a 12-month price target of $320 per share. Now let me tell you exactly why we think it's going there. It really boils down to this. The risks? They're absolutely real. We can't ignore them. But we believe the opportunity is just too big. The AI Supercycle is poised to unlock a massive wave of value from that 2.2 billion device ecosystem. Now, the biggest thing that could go wrong is if regulators across the globe actually manage to break up their high-margin services business. That's the risk. But we believe the AI opportunity more than outweighs it. Now, look, if that regulatory risk just feels like too much for you, the analysis does point out a couple of other interesting plays. You've got Meta, which is actually getting some real traction with its more affordable Ray-Ban smart glasses. And then there's Samsung, which is about to launch a direct competitor to the Vision Pro with its own XR headset, giving people an Android alternative. Apple is betting the farm on AI to drive its next decade of growth. And that leaves us with one final question for you. With this whole AI race heating up so fast, what companies should we break down next? Let us know.